Now joining us for more on Apple and the markets, Art Steinmetz. He's Chief Investment Officer at OppenheimerFunds. So, Art, you heard our report just now from Seema, and this was the talk of the day, all about Apple. From what you know about this deal, does this make sense?
Well, for who? For Apple or for the investors? It certainly makes sense for Apple. You know, they have transitioned from being a growth company to a value company over the last few years. What Apple doesn't seem to have in the pipeline right now is a lot of blockbuster growth ideas, but what they certainly do have is enormous amounts of cash on hand and enormous cash flow generation. That makes it a reasonably safe bet for bond investors. And of course, they would like to continue to increase their dividend, and they start to get a little constrained by the fact that so much of their cash is offshore, it's overseas, and they can't repatriate that without the big tax hit. So this is something that makes sense all around.
Art, you wrote a few days ago that you think stocks, U.S. stocks specifically, are ready to stand on their own 2 feet. Why do you say that, and what does that mean?
Well, it means that the U.S. economy and indeed the global economy outside of Europe continues to show reasonable signs of growth. You know, stock investors are terrified about the removal of support by the Fed, the withdrawal of monetary accommodation. And it's something that always causes enormous amounts of volatility and consternation when it happens. But remember, when that happens, it's typically because the economy is growing reasonably, at a reasonably good clip. This is subpar growth by the standards of past recoveries, to be sure, but it is growth and it is durable. So, you know, I think that the stock market is not overvalued by any means. I think it's reasonable to expect a pause and a correction, but that isn't something that would keep me on the sidelines.
Let me ask you something about this Wall Street legend that they say sell in May and go away. I think the statistics go back to World War II, saying that if you sell your stocks in May and then come back in October and rebuy, that you will do better. Given the momentum in the markets that we've been seeing so far this year, do you think that legend will hold true, and what should investors do?
You know, it's a sporting call. You know, we've seen it really to a greater or lesser degree in each of the last 2 years. But that's not analysis. That's like correlating the stock market to who wins the Super Bowl. It's certainly possible, but investors shouldn't get out of the market. But I'm not too worried about that because retail investors, small investors, aren't in the market. They've been pouring their money into highly safe bond funds, things that might invest in Apple. And taking on interest rate risk instead of equity risk is certainly not the way to go right now. And you know, who could time it with any sort of precision? If I had the strong ability to call the bottom, I would say, yeah, I would get out right now, and then I'll call the bottom perfectly and get back in. But who has that kind of deft ability? And indeed, retail investors who are still very, very scared, there's so much fear out there, certainly wouldn't do that. People would use, if I say there's a correction coming tomorrow, people might use that as an excuse to stay on the sidelines, to stay uninvested. And of course, that's been such a harmful strategy for the last few years. So even though there's corrections happen, markets fluctuate, I wouldn't use that as an excuse not to prepare the right long-term financial plan.
All right. Thank you so much for your thoughts, Art. Art Steinmetz, Chief Investment Officer at OppenheimerFunds.